Hey everyone, welcome back to another video. In this lecture, we're going to be talking about international finance. So let's talk about the types of advantages that exist. So the first kind is called an absolute advantage, and this is basically when a country is able to produce a good or service or set of goods and services at a cheaper price than other countries. So let's say that China wanted to produce silk, and they are able to do so at a cheaper price than every other country in the world. That would put China at an absolute advantage. So the next kind of advantage is called a comparative advantage. And this is when a country can specialize in the production of a good or service that they're relatively more efficient at making, or at producing, I should say. So for example, if America were to produce computers over clothes because they're more efficient at doing so, that would be an example of a comparative advantage. So here's some key terms. So the first kind is called an import, and the next is an export. So imports are goods and services that are brought into the country, and exports are goods and services that are sold to other countries. So now let's talk about trade barriers. So what a trade barrier is, it's a restriction or set of restrictions that are made to reduce free trade. So there are two different kinds of trade barriers. The first one is a formal trade barrier, which is created because of political actions. And the next one is called an informal trade barrier, which is created because of religion, culture, and the country's traditions. So now let's talk about the types of barriers. So the first one is called a quota, which is just a limit that's placed on how much of the product can be imported or exported from a country. The next kind is called a tariff or an import duty, which is just a tax placed on the imports. And the next kind is called an embargo. And this is where governments just altogether ban goods from being imported. And these embargoes are used to disapprove the actions and policies of other countries. And they're also used to protect that said country's industries from international competition. So here are some ways to encourage trade. So the first is with a free trade zone, which is just a designated area, usually near seaports or airports, where products can be imported without any taxes. So this is called duty-free. And the next kind is called a free trade agreement, which is where multiple countries agree and form an area where products are traded amongst them that are duty and barrier-free. And the next kind is called a common market, which is also known as an economic community. And this is where countries sort of band together and form trade barriers, eliminate trade barriers, and in the hopes that workers can move more freely between countries, and so that companies can freely invest in each of the countries that make up those common markets. And the last kind of way to encourage trade is called a regional trade organization. And this is where countries, again, band together, but in order to promote economic development and trade. So for example, the ASEAN promotes political and economic cooperation amongst its 11 countries, and they do so in the hopes that they will be able to foster economic growth, social progress, and cultural development. So let's talk about trade measurements. So the first one is foreign debt, and this is how much money one country owes another country. And the next is called balance of trade. So this is the difference between total exports and total imports. So a favorable balance of trade is a positive one. So this means that countries need to have more exports than imports. And a trade surplus is when the total exports exceed the total imports. And a trade deficit is the opposite. So trade deficit is when the total imports exceed the total exports. And the balance of payments is similar, except instead of total exports and imports, they subtract the money that comes into the country and the money that goes out of the country. So it's sort of like accounts receivable minus accounts payable. And like balance of trades, a positive balance of payments is favorable and a negative is unfavorable. So let's talk about economic development factors. So the first one is literacy level. So the better the education, usually the higher the productive facilities. And the next one is technology. So Automated production, distribution, and communication systems lead to efficient creation and delivery of goods, services, and ideas. That's the theory behind that. And the next one is agricultural dependencies. So this revolves around the idea that an emphasis on agriculture means that that said country, is unlikely to have manufacturing to provide a high quality and high quantity set of products. So let's talk about infrastructure. So infrastructure is the transportation, communication, and utility systems of a nation. So all of that put together, that's what infrastructure is. So we have physical infrastructure, which is the infrastructure that facilitates business activities. So this is like computer and telecommunication systems necessary for global business success. The next one is natural infrastructure. So this is climate, waterways, and any other kind of natural resources that contribute to the nation's economic development. So this could include providing an advantage when creating and distributing goods and services. And the next one is social infrastructure. So this can be families, relatives, labor unions, religious groups, and other social groups are considered when interacting with customers, suppliers, investors, and employees. So the last one is financial infrastructure, and this is the availability and efficiency of a country's banks, financial markets, and institutions. So there are three different levels of economic development. So the first is industrialized countries, and then the next is less developed countries, so LDC for short. And finally, we have developing countries. And now let's talk about international currency. So there are two different kinds. There's hard currency and then there's soft currency. So hard currency is currency that's accepted for most global financial transactions. So two of the more popular hard currencies are the USD and the Euro. So now let's talk about factors that affect the currency values. So for balance of payments, a favorable balance leads to a rise in currency, and an unfavorable balance leads to a falling currency, so dropping value. And now let's talk about economic conditions. So if the consumer prices rise, then naturally currency's buying power drops. And inflation also decreases the buying power of currency. And lastly, let's talk about political stability. So if political change ends up creating an unfriendly government, then companies are going to lose control of the factories and local bank deposits that they once had control over. And political stability happens if new restricting laws and regulations are enacted. And because of that, business people are going to be a lot more uncertainty in the country or uncertainty with regards to the country, so they're not going to have as much confidence in the country's currency. So let's talk about international stock exchanges. So the first one is the World Federation of Exchanges, and the World Fed of Exchanges is a private organization that basically coordinates the activities with hundreds of different financial markets and global stock exchanges. So their goal is to communicate with these exchanges to make those financial markets more efficient. And the next is global stock indices. So this is like the Dow Jones Industrial, the S&P 500, NASDAQ, etc. And next we have our American Depository Receipts. So the US citizens are restricted from buying foreign stocks, and ADRs can be used to allow US investors to invest in other countries. And then we have our international mutual funds. So these are meant to attract investors from all over the world. So people that wish to buy stock in hundreds of different companies. And the benefit of international mutual funds is its diversification. And with international mutual funds, you eliminate the high commissions that come with the brokerage and the currency conversion fees that individual investors would have to encounter. So international mutual funds also consist of regional funds. So for example, Latin American funds strictly investing in Central American companies. That's an example of a regional fund. And then we have our over-the-counter markets. So this is basically a pool of stockbrokers that buy and sell stocks that aren't listed on an exchange. So for example, they're not listed on the NASDAQ or the Dow Jones or any of those kind of indices. Then we have our global bond markets. So this includes international bonds. So issuing bonds provides debts financing for companies or governments. And these international bonds have a face value or maturity value. So this is how much money the bondholder receives when the bond reaches a maturity date. So this is how much the borrower has to pay at the due date of the bond, essentially. So there are a couple of concerns about bonds. So the projected returns aren't completely certain for companies that don't have a track record of financial success. And political instability can increase the risk, and cultural differences and economic difficulties can do the same. And local agencies that rate the bonds may not have the analysis techniques and the reporting standards that are comparable to the industrialized countries. And also, lastly, the buy and sell decisions of the institutional investors. So this includes the mutual funds, insurance companies, and many more. So their buy and sell decisions can affect the bond values for small, vulnerable companies. And then we have our inflation-linked bonds. So these bonds offer protection from the economic uncertainty that could happen in the near future, or just in general. And these bonds increase based on inflation. So for example, the Canadian real return bond does increase with inflation. And then we have our asset-backed securities market. So these are noted and secured by various companies, and because they're backed by an asset, they're collateralized. And common items that are used as collateral are loan receivables, and AR. So here's some other global financial documents. So the first one is a promissory note, and this is a promise made to pay a certain amount at a specific date. So this is all predetermined. And then we have our bill of exchange. So this will show the bill given by the exporter to a third party, and then that third party is going to have them pay the bill. And then we have electronic funds. So these are payments made through the bank's computer system. And then we have a commercial invoice. So these are documents used at the import location to verify if any of the imports need to be taxed. So import duties will be calculated. And this includes shipper, buyer items, quantity of the items, the cost of the items, the terms, and the payments. And lastly, we have proof of insurance. So this is typically required during an import or an export transaction. And what this does is it explains how much insurance need coverage for any disaster. So how much the insurance is going to cover for any disaster. And this disaster can be natural or it can be human. So let's talk about international financial agencies. So the first one is an export-import bank. And these guys offer insurance policies to exporters that guarantee them coverage or protection from any kind of risk. And then we have our overseas private investment corporation. And these guys provide investment insurance to US companies that are trying to expand to other developing countries. And these overseas private investment corporations, the overseas private investment corporation shields companies from things like political risk, war-related destruction, or even terrorism. And then we have our Foreign Credit Insurance Association. So these guys insure other countries that aren't receiving their payments for delivered goods. So that's it for this lecture. This is actually our last lecture, so hope you guys took something out of this course, and I wish you the best of luck in your future endeavors. Thank you so much, and have a great day.